It's my pleasure today to moderate today's session. And also, I'd like to thank the Q4 Marketing and Events team for their work in setting up the event. In addition, I'd like to recognize our partner, Navisto, who's our co-sponsor for today's session. We're all quite happy to be able to provide this forum for discussion of such a relevant topic. As we look at the agenda for today's session, let me highlight some key items regarding today's topic. I think I'm not alone in my confusion and perhaps lack of recognition in how significant these new requirements have become. Over the past year, regulatory organizations globally have pushed new disclosure and reporting changes to the forefront of their agendas. We're seeing a rapid change in the drive for more transparency, and companies are now faced with meeting challenging new rules which many are not prepared to implement. Additionally, there are a variety of organizations around the world that are generating new requirements which may not yet be aligned. So the challenges facing IR professionals and the teams in their companies who work to provide ESG insights are tremendous. Now, before we get started, let me remind the audience that we'd like to incorporate your questions. Please submit any questions you'd like discussed by using the Q&A function on your screen, and we will try to work those into the discussion as we move along. Today, I have the pleasure of speaking with Marie-Josée Privac from Navisto. In addition to having a more difficult name to pronounce than Nunziati, I've come to realize that she's an amazingly knowledgeable resource on this topic. As I think you'll all see, we should be set for an interesting discussion. And fortunately for me, she goes by MJ. So MJ, I'd like you to provide the audience with a brief background now and some details on your current role, and then we can dive into the topic.
Thank you. I appreciate the intro and appreciate the invitation. Very happy to be here and to talk about this, as you mentioned, very important topic. A little bit about me. I'm currently Chief ESG Innovation Officer at Navisto. Navisto is an ESG data management software platform, a tool for corporates to facilitate, accelerate collecting, securing, storing, and using quality, audit-ready ESG data. My background is actually capital markets. I was a sell-side financial analyst for many years. I also worked as a director of investor relations for a publicly listed company, so quite familiar with the demands of capital markets, the need for quality information, have been in the ESG, sustainable finance, sustainability reporting space for the last 12 years, and really came to it through the investor relations lens, or the investor focus. So the focus on material information, information that is decision useful, that is really helping investors integrate these considerations into their analysis, their fundamental analysis, and their investment decision making. And so through the years led me to doing some advisory to help companies actually address the disconnect that exists between the information that they make available or don't and the information that investors are looking for. And that ultimately led me to Navisto.
Excellent. Well, we didn't talk about this when we met earlier, but it didn't occur to me that 12 years ago, I mean, ESG was really in its infancy. What was the attraction that had you shift from IR into advice on ESG?
Great question. I wish I knew exactly what happened, but I can't remember. But to me, it was a little bit of an aha moment. I think I read an article. Somebody gave me an article to read on sustainable development or responsible investment. It had been around for a while, actually, but it was definitely, I would say, at the inflection point of the hockey stick curve, if you will. There's been an acceleration of interest and growth in this topic, and a shift towards this way of doing things around that time. And to me, it was just like commonsensical, the way businesses should be run, the way capital should be allocated. I think it did a lot to give finance its purpose back. Why are people in finance doing what they do? What does money serve? What do investments serve to achieve? So that might have been a part of it, but didn't look back.
That's great. And I think you're right in terms of the sort of the purpose driven. I think a lot of the attraction around the idea of working for a company that's doing something that that personally you align with is important, and it's becoming even more important now for so many people in the workforce. Absolutely. Well, yeah, that's great. Thank you for your background and introduction. Now, let's get started maybe with the sort of the foundational level. Maybe can you explain for the audience the new corporate sustainability reporting directive, just to add additional acronyms, and the European sustainability reporting standards that companies will have to apply, and highlight why those are being implemented.
Sure. And I will start with a higher level view to provide a little bit of the context and the why. I think it's always important to remember why. Why are we doing this? Why is the European Union doing this? What is the ultimate objective? And the European standards are mandatory standards as part of the Corporate Sustainability Reporting Directive, which is a regulation, or the precursor to the regulations, and I'll get to that in a sec. But the CSRD is actually part of a larger plan, if you will, that is the European Union's, the Green Deal, which is their sustainable economic growth strategy, which they presented, 4 years ago now. And within the Green Deal, they also put together a comprehensive policy agenda on sustainable finance, which is called the EU Sustainable Finance Action Plan. It's comprehensive, it's multidimensional, and it really does encompass actions and so regulations for corporates as well as for investors. So the corollary regulation for investors is the Sustainable Finance Disclosure Regulation. And that's mandating and governing the disclosures that investors have to comply with in terms of sustainable finance. The Corporate Sustainability Reporting Directive is a directive, it's not a regulation, and therefore it needs to be translated into national regulations by the individual members of the European Union. They have a year to do that, so you could expect those to come out in the next within the next 12 months. They have to come out in 2024, but for all intents and purposes, we can consider the Corporate Sustainability Reporting Directive as the regulation. And it was created to strengthen sustainability disclosure and accounting rulemaking, to foster greater transparency and long-termism as part of that longer-term sustainability strategy writ large, if you will, of the European Union. It actually replaces and augments a previously existing regulation, which was a non-financial reporting directive, which was already in place. Fewer people know about that, but they're not starting from scratch. The very largest companies in Europe already had reporting obligations. However, they were very, very vague and not necessarily properly complied with, if you will. And the reason that the EU felt they needed to come out with this new set of regulations is really to address what was and has been relatively low quality of corporate sustainability reporting, because it was voluntary, because it wasn't standardized. So a lot of standards and frameworks came into the market to try to address that, but then everybody got confused because there was many standards and frameworks to try to implement. And it is meant to address the very, very loud calls we started hearing from the G7, from the Financial Stability Board, from a number of different, government bodies and organizations for widely available, comparable, reliable disclosures. And the purpose of the CSRD is really to provide that to the markets and to better meet investors' information needs, because one of the big drivers for corporate disclosures in the sustainability ESG space is investors. Increasingly, there are others, large companies, definitely coming up the ranks, but investors are a big driver. And as we all know, what investors want, companies will seek to comply with. But that has been done in a little bit of a haphazard way until now. So the regulation is seeking to consolidate that. So essentially what the CSRD is saying is companies are going to need to disclose a very much broader scope. We'll talk about that in a minute. Who are the companies that are in scope? The companies are going to have to disclose on their sustainability performance. But not only that, they're going to have to apply a specific set of standards, which is the European Sustainability Reporting Standards. Their disclosures are going to have to be externally assured or audited, and their report is going to have to be digitized and XBRL tagged. So regulations make the disclosures widely available, standards make them comparable, audit makes them reliable, and digitization and tagging makes them discoverable and shareable and readable by both humans and machines.
I mean, that's a big deal, and I think those four aspects really, that's what struck me as being sort of maybe surprising, and many IR teams, I think, probably unaware, and now hopefully we'll be able to share some of that, particularly with those that have internal teams that are focusing on it. I also just wanted to touch a little bit. You mentioned investors being kind of, and I've always felt investors are the primary audience for all information around ESG, even if you thought back to just the early days when IR teams were just sharing governance information, succession plans, and board attendance lists. But I think you also said companies. I was thinking also, employees. Often we talked about wanting to align to your company's mission. But what would another company's interest be in a public company's ESG information?
Yeah. So what I'm referring to there is large companies that are managing their supply chains. So in terms of sustainability management, reporting, and even legal obligations, as we're, the regulatory initiatives that are coming out, a lot of them coming out of Europe, but many other jurisdictions as well. There is this increasing scope of responsibility, not just to the core business of companies, but to their entire value chains. That is actually baked into the European standards and the IFRS sustainability disclosure standards as well. This concept of you must look at your material impacts, risks, opportunities across your value chain, upstream suppliers, downstream customers, as well as your core business. So more and more, in order to demonstrate what they're doing in managing their supply chains, are turning directly to their suppliers, indirectly through third-party solutions that specialize in supply chain management, or directly to their suppliers and asking them to provide them with information about what they are doing, disclosures being a proof or demonstration of what you are doing, which is the same concept as in public markets, right? You're disclosing on what you're doing. So it's a little bit the same thing, and that's what I was essentially referring to.
That's helpful. Yeah, I hadn't connected the fact that the supply chain aspect is going to be critical, especially when you think about the stringent requirements that companies are subject to now, or will be subject to. So maybe now that's a good chance to dive in a little bit, understand what will actually be involved in reporting. You talked about the digitization and who has to actually comply with this.
Absolutely. And I'll start maybe with who has to comply, and then I'll dive maybe a little bit deeper into the standards and the scope of the standards. So who has to comply? The CSRD is expected to target in total around 50,000 companies when all is said and done. And it is a combination of large companies as well as small companies, and public companies as well as private ones. So it's not limited to any one of those sub-segments. You might have seen articles also that were stating that there would be a lot of non-EU companies, up to 11,000 non-EU companies that would actually be subject to the CSRD disclosure regulations. That 50,000 number includes those 11,000 companies. So any company that is publicly listed in Europe would be subject. Any company that is domiciled in Europe, so not necessarily public, but domiciled in Europe. There is a threshold to identify regular-sized companies subject to the initial set of standards versus smaller companies. Smaller public companies will need to comply, but they will have a lighter set of standards. Smaller private companies will not have to comply. They will be encouraged to comply, and there will be a set of standards for them as well. So much lighter set of standards for small private companies. And by small, we're talking very, very small. The threshold for being in scope for the CSRD, for the main set of standards, is to meet 2 out of 3 criteria, those 3 being a minimum of 40 million euros in revenues, a minimum of 20 million euros in assets, and 250 employees or more over the course of the year. These are not very high thresholds for size. There are a lot of companies that fall in scope of the regulation with this size. For non-EU companies, if you are neither listed nor headquartered in the EU, if you have substantial operations in the EU, we're talking 150 million euros of revenues generated in the EU, and you also either have a subsidiary that would meet those size criteria or a branch that has revenues of at least 40 million euros, then it gets complicated. It is not a simple regulation, by the way.
What a surprise.
Yeah, exactly. It's very, very comprehensive. Then you would be subject to the regulation, to disclosures. What that means, and so I'll just finish my thought there on non-EU companies, and maybe we can circle back to it. Is that the EU operations would be subject to the disclosure regulation and have to apply the standards as any other company of that size that would be domiciled in the EU. But over time, by 2029, for the fiscal 28 reporting period, even the parent company would be subject to disclosures with a different set of standards, or a lighter set of standards, a set of standards that the EFRAG, which is a regulatory body, would determine to be suitable or equivalent. But nevertheless, within the next 5 years, even the parent companies, if they have operations in the EU of this size, would have to have a consolidated sustainability report. In the interim, again, where it gets a little complicated is if you have subsidiaries and operations that would make you in scope of the CSRD, instead of just the subsidiaries reporting, if the parent company decides from the get-go, from day one, okay, well, I'm just going to do a consolidated report, they can do that. And then the subsidiaries don't have to disclose separately. So there are some variations. And by the way, there's no way we can go through all the details and make this crystal clear for everybody in a first pass and in a 1 hour conversation. So there's obviously the need to go back to the documentation. There's going to be, there's already some guidance that has come out into the market, whether with the consulting firms or even with the EU, the EFRAG, which is the body that is developing the standards, has promised to come out with guidance. There's going to be a lot of that, a lot of tools to help companies understand what this is all about. So maybe this is just to give some flavor and give some indications of where to look.
Sure. But when we think about that, because you mentioned, potentially 2024 being the beginning of this. So there is some, runway here, but the timeline is pretty critical right now.
Yeah. And so maybe before I go into the standards themselves, or kind of give a flavor for the standards, or what the standards are expecting companies to do. In terms of the timeline, so for the very large companies that are already subject to the NFRD, they have to report using the standards in 2025 for their fiscal 24 reporting period. So for the next report, not this one that we're in currently, but for the next reporting period, when they produce their report in 25, they will have to apply the new standards and comply with the new regulation. For all the new companies that are now in scope, so we're not subject to NFRD before, but they meet those size requirements, the 250 employees, 40 million revenues, 20 million assets, it would be for their 2025 fiscal year. And so the report that they would be producing in 2026. For smaller companies, it's 1 to 2 years later. They can defer by 1 year. So the smaller public companies would be in 2028 for their 2027 reporting period. And then the large parent companies, the non-EU parent companies that have in-scope activities, that would be in 2029 for the 2028 reporting period. So there is, some time, definitely more time for smaller companies than larger ones. There are other provisions, phase-in provisions also again, too granular for the purposes of this conversation, but there are some transition and some phase-in measures that have been included in implementing the CSRD and the European standards. Maybe I could jump back to some details on the standards, or do you want to bounce off of the time frame?
Yeah, maybe just one other thing on that time frame before we talk about the details, because I hadn't connected also the fact that the requirement for these submissions to be audited, all of that has to be built into the same time frame. So if we're talking about 2026 reporting for 2025 results, I'm assuming that means that audit teams are going to be engaging earlier in that timeline.
Oh yes. I think that when we talk about the CSRD, the ESRS, and you mentioned it at the beginning in your introduction, that it is quite a substantial development. It is a big lift. It's a step change for companies in terms of their reporting practices and what they need to build and develop internally in order to comply with these disclosure obligations. And companies have waited until the regulation and the standards were finalized. It seems for many, waiting to see, is this really going to happen before they actually start to engage. And it's going to be a pretty tight timeline. And it's going to force a lot of changes within the companies and those sustainability reporting teams that have historically been doing this work. A lot of work, great work, but it's going to be called upon to change even more substantially. Because with that external audit piece, and I think you're underlining it for a very good reason, that brings with it the whole data quality mindset, internal controls, processes, and mindset that until now have largely escaped the sustainability reporting practice. It also pulls in a lot of other departments. It pulls in compliance, it pulls in finance, it pulls in the C-suite and the board with oversight. There's a need to have oversight on this, and not only a need, they're going to want to, because now it's regulated. And all of these different departments now that have perhaps by and large been, I don't want to say avoiding, but have been spared or have been, having only a cursory involvement in the sustainability reporting practice, are now going to be heavily involved. And that's good in a way, because that is exactly the purpose of the regulation, which is to get companies to do more and to manage their material issues, their material impacts, risks, and opportunities, those that can impact their ability to operate and to generate cash flows and to be successful over the long term, but also those issues that they are impacting through the conduct of their activities, which is about how they interact with their ecosystem. Are they damaging their ecosystem? Are they improving their ecosystem? And by ecosystem, we mean the natural environment, natural resources, but also society. And so all of the social dimension of their activities. And so that's when we start to get into the concept of double materiality, which is a founding principle of the European standards.
Yeah, let's hold that one. But you want to talk a little bit more about some of the details.
Yeah, so if we take a deeper dive on the standards, going back to the regulation is essentially four things. You have to disclose, use the standards, have them audited, have your report digitized. The standards is obviously a big chunk. The standards is actually, the first set of standards is 12 individual standards, 10 topic specific, and 2 general standards. In terms of statistics, they had done run some numbers on the statistics. It was something like 1,144 unique data points and 82 disclosure requirements. Are companies going to have to disclose on 82 disclosure requirements and 1,144 data points? No, hard no. The overarching principle of the standards is materiality, which is focus on those issues and those disclosures and those data points that matter to you, to your business. Now, whether they matter because of how you're impacting society and the environment, or whether they matter because of how the issues are impacting you, it's all one and the same. Ultimately, there is a need to do almost an impact assessment, really, to determine what those issues are. But what's very interesting about the standards is they are not prescribing. There's no disclosure that is mandatory for everybody. So anybody who's been following the space a little bit, at some point they had wanted to make climate disclosures mandatory for everybody because, fundamentally climate is material, it can be material for every business in one way or another. They've walked back on that, and they basically have said for all disclosures, it's you determine whether you disclose based on whether it's material. However, for climate and for some of the data points that are required as part of the disclosure regulations for investors, if you don't disclose, that means that you consider it to be not material, and then you have to explain why. So if you're not going to disclose on climate, you're going to have to explain why climate is not material to you. And by climate, it's not just your emissions. It's not just your scope 1 or 2 or 3 emissions. It's transition risks, physical risks, long-term impacts on your business, and again, your business, your entire value chain of the consequences of climate change. A lot of companies may have very little emissions, and they may themselves not necessarily be exposed to any of the physical risks associated with climate change or even transition risks. But when you start to look at their value chain, whether it's their suppliers or even their customers, that picture might change completely. So back to climate change, if you are not disclosing on climate change, you have to explain why it's not material to you. So same thing for the principal adverse impact indicators that are mandatory for investors to disclose on. But everything else is, if it's not material, don't disclose. You don't need to explain why. And this materiality principle I find very interesting is that it's applicable not just to the topic, but even to the data point. So even if there's an issue that you think that you have come to determine is material, you have to disclose. If the particular data point that is prescribed by the standard is not relevant to you, you could choose not to disclose it. Now, technically, you should have other data points that you do think are important to you, that speak to your performance and speak to how you're managing the issue, that you must include. So the standards are enabling companies to identify topics that are not in the scope of the standards currently. There are going to be more that are going to come out over time, by the way. This is the beginning of a very long process of more standards for small companies, sector-specific standards, and more topic-specific standards that are going to come out over time. But if there's a topic that's particularly material to you and there happens to not be a European standard for it right now, you still must disclose, and you just disclose what you consider to be material information or relevant information, relevant for the users of the report. This concept of, what makes information relevant, it's if the users of the report need it to make their decisions. Who are the users of the report? They are both capital market participants, so investors, but also lenders and insurers, because lenders now, as they are themselves looking to incorporate sustainability into what they're doing, they're looking at their loan portfolios. Insurers are looking at their insured portfolios, the assets that they're insuring, and they're all wanting to have this kind of information as well. And then the European standards are very multi-stakeholder focused, so it's investors plus any other stakeholder that is making a decision that can potentially affect your business or that needs this information in order to make their decisions and do their thing. So it can be quite comprehensive.
Yeah, and that sort of any interested stakeholder takes away an opportunity to maybe opt out. I want to work in one of the questions that came in from the audience because we talked about digitization. the question was, is this already a requirement for financial disclosures, or is this different maybe than the requirement for financial disclosures?
Yeah, excellent question. Depending on your jurisdiction, it is already a requirement for financial disclosures. So it is a requirement already for financial disclosures in Europe. It's also already a requirement for financial disclosures in the US. Form 10Ks have to be filed in XHTML, and they have to be XBRL tagged. So this is very much about bringing things that exist in financial disclosures to sustainability disclosures. And I think that's probably an overarching takeaway here as well, is this convergence between financial and sustainability reporting. As a matter of fact, the CSRD is mandating that companies put this information in their management report, which is essentially in Europe the regulatory annual report, and that it be for the same reporting period, fiscal year presumably, and that it be obviously, because it's in the same report, it's reported at the same time. That's quite different than the reality we have today, where the reports are separate. They used to sometimes be for different reporting periods. That's changed. They are now generally for the same reporting periods, but we still get sustainability reports that come out many, many weeks and sometimes many months after the financial reports. And investors are basically saying, well, that makes no sense, because I need to correlate your performance from a financial standpoint to your performance from a sustainability standpoint, and how the two are interacting, how sustainability performance is likely to affect financial performance. That's another key driver here, or key intention and objective is the interconnection between sustainability and operating and financial performance, and how one can affect the other, which then leads us into this concept that these disclosures are by and large very forward-looking. There is a much greater forward-looking dimension to sustainability disclosures, because we don't really want to, well, the past is informative, but really what we want to know is, where are we going? What's going to happen in the future? That's when you start to talk about setting targets and impact, right? How is your performance in the future going to be different or better than your performance in the past? How are the issues likely to affect you in the future? Climate change analysis, scenario planning is very forward-looking and very long-term forward-looking as well. We're not talking 1 year out. We're talking 2, 3, 5, 10, 15, 20 years out, which again changes the dimension of what may constitute a material issue. 1 year out, not such a big issue. 10 years out, 15 years out, possibly very significant issue. So all of those things are changing the game.
Yeah, well, and being able to incorporate that into the way you talk about how you'll manage the business to address those risks that you've identified. Another maybe follow-up audience question, and I think you highlighted this, but the question was, does the UK have to follow CSRD, given they're not part of the EU? And I guess you could substitute UK for US, Australia, any other non-EU.
Yeah. So what's happening elsewhere in the UK? Indeed, because they are no longer part of the European Union, they've gone their own way, but they have equally ambitious, green economy, sustainable finance plans and aspirations. And so they've been developing their own set of policy initiatives. And 3 weeks ago, they had mentioned their intention of doing these things. But 3 weeks ago, they officially said, following the final release, or the release of the final version of the first 2 IFRS sustainability disclosure standards, they announced that they would be issuing their own corporate sustainability reporting regulations, and that they would be mandating standards, and those standards would be those of the IFRS sustainability disclosure standards, with perhaps some adjustments for the UK market, but nevertheless, in essence, the IFRS standards. So similar objectives, similar ambitions, slightly similar approach in regulating disclosures with standards, and I suspect it will be IFRS sustainability disclosure standards, audited and digitized. The main difference will be the application of the standards between the UK and Europe. So that, we could talk maybe if we have time about how the IFRS SDS and the ESRS compare. Let's save that one for later. That's a juicy one. In other jurisdictions, I mean, the US, all eyes are on the US, of course. The US is, still the largest capital market in the world. They have chosen to take a slightly different approach, but in my opinion, in the end, will significantly converge with what we're seeing in Europe, in the sense that, first of all, the SEC is a regulatory body. They're focusing currently on climate-related disclosures. They have a draft disclosure rule that we expect to be finalized by the fall. It's actually late. It should have been done already, but it's taking longer than planned. But it's still widely expected to come out in the fall. And what that disclosure rule is saying is, if climate is a material issue for you, you must disclose. And actually, they're outright mandating Scope 1, Scope 2 emissions, because they basically said investors want to know your Scope 1, Scope 2 emissions and a few other data points. So you must disclose those. If you are going to set targets, so you may have noticed a lot of companies are coming out with their net zero targets for 2050, and everybody wants to be carbon neutral. And the SEC is basically saying, if you're going to set those objectives, you have to document them. You have to specify how you are going to achieve them. And you have to set interim targets, which is actually really good practice. And that's just a way to address and minimize and avoid greenwashing. A lot of companies are setting very ambitious net zero targets. They have no clue how they're going to reach them. So to be able to say, I'm target neutral, I'm going to be target neutral in 2020, but I haven't started doing anything about it, and I have no idea how we're going to get there, that's, a little bit perhaps contentious. And the part of the reason why the SEC's come up with its regulations is to address that. So, and they followed the recommendations of the TCFD, the Task Force on Climate-Related Financial Disclosures, those 4 pillars, 11 recommendations. The SEC has really closely followed many elements of the TCFD recommendations, but also they've mandated that those disclosures have to be externally assured and they have to be digitized and XBRL tagged. What people have maybe not noticed, and that because it's gotten a lot less attention in the press, is the fact that a few weeks ago, the SEC issued its final cybersecurity related disclosure rule. And very similar, companies need to disclose a certain set of information on an annual basis, their governance of cybersecurity related issues, why they may be material, how they would be material, how they are likely to affect their operating and financial performance. And if they have a breach, they have to disclose it within 4 days. So this kind of like, we had a breach 6 months ago, by the way, and yes, X thousands of customer data were stolen, or those kinds of stories. Yeah, that would come out a lot sooner. They've stopped short of making those disclosures externally assured, but they will have to be XBRL tagged. Mm-hmm. So I would suspect the SEC might be taking more of this topic-specific approach, very much aligned with their remit, which is regulating the information flow to capital markets to make capital markets as efficient as possible, very much reflecting the fact that this is what investors are demanding. But in the end, I think we're going to converge to very similar practices as what we're seeing in the EU. And then, I mean, jurisdictions, many jurisdictions, Australia, New Zealand, Singapore, Hong Kong, India, are mandating sustainability ESG disclosures, looking into the XBRL tagging and the assurance of those disclosures. So the strong convergence.
I'm wondering now, when we think about that, sort of similar path that the SEC is following, whether that will also lead to similar requirements, as we discussed earlier, that non-U.S. listed companies or U.S. headquartered companies might be required to meet SEC requirements if they have operations of a certain size in the U.S. Do you think that that's likely?
Yeah, interesting question, because already companies that are not U.S. domiciled, but that are listed in the U.S. So we have, in Canada, we have quite a few Canadian companies that are dual listed. Sure. They have to meet those obligations, those disclosure obligations as well. So for public companies, I think the precedent's already been set. What you're asking is not necessarily public, but private companies. Interestingly, we are seeing governments come out with regulations on disclosures for companies that do business in a particular jurisdiction or that are domiciled in a jurisdiction, whether or not they're public. And one really good example, actually, there's two good examples. One is California. The state of California is in the process of finalizing regulations to mandate climate disclosures for any company doing business in California that has more than $1 billion in revenue. So that's a relatively high threshold. But when you think of all the software tech companies, that's, you know, perhaps many companies in scope there. Mm-hmm. And the other example I'm a little less familiar with, but it's out of the state of New York, that has made mandatory disclosures for companies in the apparel sector. And I believe it's about it's the supply chain, sourcing, and procurement, and specifically with respect to human rights violations. And again, this is state governments, and it's for companies in the jurisdiction or doing business in the jurisdiction. I think you may start to see more and more of that as well. And in Europe, again, you know, there are so many examples that we can follow from them. They're also coming out with regulations that are prescribing what companies should be doing. So not necessarily what they should be disclosing. So one of the examples that comes to my mind is the Corporate Sustainability Due Diligence Directive, which is basically telling companies, again, similar scope to the CSRD, but they need to do the due diligence to assess possible human rights violations in their supply chain, and if they find any, take action to, you know, reduce, eliminate, avoid, compensate for human rights violations, as well as climate action. But you know, and it's a pretty hefty requirement. So yeah. I think we're going to see more and more of those.
Yeah, hefty and getting heftier. There was a question from the audience I want to make sure we cover, talking about the ESRS already requiring shareholder engagement. What should organizations understand from that requirement, and you know, does shareholder engagement end up having to be included as part of this reporting? Or stakeholder, I should say, stakeholder engagement.
Yeah, I think stakeholder engagement is in relation to the concept of materiality. In other words, in determining what issues are material to your business and that you should be reporting on, reach out to your stakeholders to understand, you know, how they may be impacted by your business. And so I think that's not necessarily new. And for anybody that is familiar with sustainability reporting, and in particular the GRI standards, very, very similar. So the GRI standards, because these are standards that are, you know, 3/4 of companies that have a sustainability report follow to some extent the GRI standards. They've been around for a long time, excellent set of standards. They actually officially collaborated both with EFRAG in building the European standards and IFRS Foundation in building the IFRS Sustainability Disclosure Standards. So and the European standards are very closely aligned with the GRI. They go even further than the GRI, I would say, but they're closely aligned to the GRI. So this whole concept of stakeholder engagement to try to understand how you are impacting your ecosystem, the people that depend on your company, the people that make decisions that can impact your company. I think that's not a new concept. I don't know that you have to, actually, I was going to say, I don't know that you have to actually disclose on it. You do have to give information about your process for determining your material issues. And if I'm not mistaken, it's also in scope for the external audit of how did you determine your material issues. I don't know that you have to disclose in too much granularity who you're reaching out to or how you reached out to them.
Great. You know, we're talking a lot about these as requirements. What's the compliance mechanism? How will enforcement happen?
Yeah.
As these become reality?
Yeah, great question. My understanding is that these compliance requirements or the enforcement mechanism the enforcement mechanisms are going to be detailed and explained in the individual jurisdiction regulation. So as I was saying earlier, the CSRD is a directive. It has to be translated or converted into a regulation by every nation state. When they do that, in those regulations, they will stipulate what the enforcement mechanisms are. I would suspect that they will be similar to enforcement mechanisms for regulations on financial disclosures. And I would expect the regulatory bodies, ESMA in Europe, just like the SEC in the US, they do their annual checks of corporate reporting, and then they send comment letters about things that need to be improved, addressed, redressed. Probably not too many restatements, certainly not in the early years. The comment letters in the early years will probably be more helpful than anything else in terms of guiding companies. But I think it's important to know that that oversight mechanism is going to be expanded beyond financial disclosures to include sustainability disclosures. It's already happened. You've seen already the SEC. Well, they issued even an example of a comment letter that they would issue on climate-related disclosure reviews. And I think they've actually released or having sent comment letters to companies on their current disclosures. What's also very interesting in the SEC is that they are comparing information in the sustainability report and in the Form 10K. So the gaps between the two are going to need to close. I mean, they're going to close when regulations are making those disclosures part of the regulatory filings. But in the interim, I think it's also important to note that regulators are looking at all the disclosures, not just the regulatory piece, to make sure that there's consistency, coherence between the two, and that you're not saying one thing in one that you're not saying in the other.
I mean, and to your point earlier, that's not unlike what we see in the financial environment, where if you had something, let's say, in a press release that wasn't in your 10K or 10Q, you may get a letter from the SEC pointing that out and asking for clarity.
Yep.
So I can see how that would drive towards that. I want to talk a little bit maybe about implications. We talk to a lot of different investor relations professionals in different phases of their journey. Some IROs are, they are the driver of all of this activity in their company. Others maybe contribute to the effort. It's led by someone else. Others are purely customers of a large team, perhaps, that is driving a lot of the sustainability and ESG reporting. When we think about that landscape, what sort of activities do you think that, actions that they need to be thinking about as this starts to unfold?
You mean IROs in particular, right?
Yeah.
I think IROs play a really critical role. And again, like you mentioned, depending on the size of the company, depending on the sustainability reporting maturity of the company, may already be very involved or not at all involved. I would say overall, with what is happening in the market right now, the first thing is know what's going on. Be aware of what's going on. And even if it's not in your current jurisdiction, just taking a larger lens to what's happening globally, because I think the trends are global, investors are global, and they will have an influence on multiple jurisdictions, even beyond their initial markets. I would say seek to collaborate with as many people as you can. Sustainability, successful integration of sustainability requires it being integrated into all aspects of the business, all the different business functions where these issues might live and need to be managed, but also senior management, board level governance oversight, ethics and integrity, culture, disclosure, compliance, you name it. And so it's not a one-person thing. Usually companies form committees to have that collaboration, that exchange of information, that contribution from the different subject matter experts. And so I would say plug into that if you're not already plug into that. Be prepared to answer questions from investors. You're going to get questions. Are you subject to CSRD? Are you planning to adopt the IFRS standards? And if you're not subject to CSRD, how is that still going to influence your reporting practices and how you're going to evolve your reporting? Because, we talked about, the CSRD being for, EU listed or EU domiciled companies, as well as non-EU companies that have activities in the EU. But even if you don't have activities in the EU, if your competitors do, if your competitors are in the EU and they start increasing their disclosures and getting a lot more granular with their material issues, with how they're performing, with their expectations and their targets, I think there might actually be a knock-on effect of, companies are always looking at their peers, always comparing themselves to their peer group to at least, stay in the pack. If the quality of the disclosure is improving for the pack, they may choose to follow suit, even if they don't actually have to. So I think those are things to consider. And I would say IROs also play a really important role because, they are that conduit of information, right? Of company information to the market, but also of market information back to the company. And when we talked, there was a question earlier about stakeholder engagement. One of the most important stakeholders for these in this context is investors. They're one of the primary demanders of this information. Is find out, what are your shareholders looking for? What are the issues that are material to them that they want to know about, information that they need to have to do their analysis, to select their investments, to go back to their investment committees with. You may also start getting a lot more engagement on the part of investors, because that's part of the things that they have to do as responsible investors. If they're signatories to the PRI, they have to engage with their investee companies on specific issues and on their material issues. So if you haven't already started to feel that, it's coming. And so they play a very key role in bringing that information back to the team in terms of figuring out what is it that we need to put in our reports, especially in the context of the European standards, which is, basically telling you, figure it out and disclose on what you've identified to be material.
Yeah, I would imagine that IR teams would be starting to get questions, maybe particularly from European investors, but even from U.S. investors who are aware of these new requirements rolling out, anticipating, how will you be meeting this? What sort of things? And that expression of interest should be something that the IR teams bring back, either to their internal ESG team, or maybe it's to their legal counsel, to really begin to set the tone for the need to meet these requirements. And I think particularly when you think about the fact that, there's going to be need for not only resources to do all of the reporting work and ensure that it's able to meet the standards for the submission itself, but also the engagement with audit capability and potentially the overlap. I mean, I think about the attestation of an audit report of your annual report today in the U.S. and the work that goes into that, as you mentioned, internal controls and the scrutiny behind that. It's not going to be just sort of like, oh yeah, they have a spreadsheet and they submitted the answers from that spreadsheet. So, any advice, resources that you'd point out as we get close to wrapping up here?
Advice: pace yourself. It's a long game. However, it's not a fad. Anybody thinking that this is just going to go away is, I think, mistaken. I think this is a seismic, paradigmatic shift in how companies report and even on how they manage themselves. I mean, the underlying purpose of this is really to drive behavior change towards more sustainable practices, and even what is more sustainable. Ultimately, the goal is to be sustainable, and that can take us into a whole other conversation. But the reason why this is happening is really because there needs to be a change in how we do business, what we choose to produce in terms of goods and services, and how we produce those goods and services. And I think that all companies of all sizes need to be taking this into account, because that's just how business should be done. And it's actually good. It's actually good for the company. And another piece of advice, this is not a cost. This is an investment. This is not something that is separate from strategy, business model, risk management, long-term management and planning for success. It is integral to it. And expect the pace of change to remain high. As I was saying, pace yourself. It's a marathon, not a sprint. In terms of resources, I mean, be discriminate. There's going to be a lot of resources. I say go with the ones that you trust and that you know are reliable. And you don't need to have 25 different resources telling you the same thing. It's kind of like sell-side analysts, Investors don't listen to the 25 analysts that cover them. They listen to the two, 3, 4 that they trust the most and whose judgments and valuations or assessments they respect. I'd say take a similar approach to that and go to the source. The European Commission, IFRS Foundation are going out of their way to produce a lot of information directly. So go to the source, read the documents, read the standards. A lot of companies have not read the standards that they purport to apply. Read the standards, read the documents, be familiar with what's going on.
That's excellent. Thank you. Well, I think we can probably get ready to wrap up. But once again, MJ, I really want to thank you for taking your time today to share your thoughts. I mean, this is super helpful for me. I hope the conversation has helped the audience understand and better clarify the impact of these changes and hopefully helps them begin to develop plans for their next steps, wherever they might be in that journey in ensuring the success of their program and solidifying their company's ESG efforts. And also absolutely. And thanks once again to Q4 and Navisto for their support in making today's session happen. We look forward to our next opportunity for discussions of best practices and emerging challenges. And until then, thank you all for participating.
Thank you very much.